This webinar is now being recorded, and let's kick it off. So, hello everyone, and welcome to today's webinar. We will discuss about proper money management in FX. First of all, with the agenda. First, we're going to kick it off with a small introduction. Then we're going to discuss about price action versus mean reversion. Then about account sizing. Then how to set your risk levels when trading FX. Then we'll discuss the different currency trading dangers that you might face, and then we're going to end this with the Q&A session. Please spend 30 seconds going over this disclaimer. Okay, now that we have this out of the way, let's start with a small introduction. So, first of all, who we are. We are Blue Sky Forex, which is part of Blue Sky Binary, an educational research and trading group that comprises of senior traders that teach various strategies, and we offer 24-hour trade support and analysis that allow binary option and Forex traders to trade in a safer way. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. And you can find more information about us if you go to blueskybinary.com. Now, having said this about ourselves, let's get into the meat of this presentation. Let's discuss about price action versus mean reversion. First of all, there are two types of strategies in currency trading. Price action is the first one, and price action is a lot more powerful. We are sure that you have come across the phrase, the trend is your friend. However, identifying it is a bit more difficult as the trend needs to be fueled by news in order to carry serious weight. So this means that whenever you see the price moving to a certain direction, this doesn't mean that you can go ahead and implement a price action strategy, because for the movement of the price to actually continue going in the same direction, for the price to continue going in the same direction as the previous movement, it needs to have been fueled by news that will have pushed the price towards that direction. Okay, so for price action strategies, is important. It's very important to have presence of news. Okay, that's the first thing. Now, mean reversion is the opposite, and it's a lot more common. It's very easy to identify, but it can be very profitable too. Mean reversion means that although you see the price moving to a certain direction, then because it's not fueled by news and it's not fueled by anything else that is going to continue pushing the price towards that direction, it means that the price is going to start going back to the mean, i.e. to the previous price levels. So it's going to keep moving sideways. So therefore, you can take a position opposite to the previous price movement. Again, if it is not fueled by news. Now, all types of strategies that fall into the above categories require very sound risk management procedures on your behalf in order to ensure that you are not hit by a margin call or face a countering. Okay, so it's very important to know that having a correct strategy is just about half. It's about 50% of the success that you can get. You always need to take care of money management and how you handle your trades and how you handle the sizes. Okay, we're going to be discussing this very soon. Now you need to know that the current environment makes risk management very topical. Many known unknowns, euro risk, dollar risk, oil risk, with knock-on geopolitical risk. So there are too many factors going on at this stage. So you need to keep your eyes and your ears on the news, right, for everything that's happening before you actually make a trade, take a decision. Now, let's discuss about how you could determine your account size if you're a retail trader, which you are. Having too little money in your account can pose a problem. And hear me out, and then we'll discuss about the problem of having also too much money in your account. Psychological impact of working hard to win trades, but then not making enough dollar profit on the payout could lead to overtrading. Imagine you start with your account, let's say with $200 or $300, which is considered to be on the low side, and then each trade you have to make actually gets you a profit of, if you want to trade safely, it will give you a profit of $10, $5, $15, something like that. This means that you are getting too tired, too emotionally exhausted, and too physically and mentally exhausted, only to win like 10 or 5 or $15, which will eventually lead to overtrading, because those 5, 10 or $15 won't be enough for you. Okay, so having too little money in your account would be a problem. Now, small capital balances can result in trades being taken that are too much percentage of your total balance, which will lead to excessive risk. As discussed earlier, having an account of $300, $400, and if you decide to take a trade that could result at a stop loss, let's say that will keep a stop loss of $50, that's 12%, 12.5% or whatever of your capital, okay? And if it's $50 out of 300, that's 16% of your capital. That's too high. You cannot be taking trades with such a high risk, okay? A good amount to start with is from $5,000 and even a little bit $3,000, but no more than $30,000. Anything over $50,000 may result in a lack of respect for your capital in taking more undisciplined trades. This depends on whether you are a retail or institutional trader. If you're an institutional trader, then you can bet higher amounts, right, if you want to, but again, not a lot larger, okay? This is very important, guys. So please be aware of all the amounts that you're trading, okay? Especially don't take excessive risk. Always size your account relative to your personal equity or net asset values, excluding debts owed. Risk capital should in general not represent more than 20% of your net asset values. So basically, if you have, what this means is that your account balance should never be more than 20% of your net asset value, and that also is a lot. Okay, so if you have 10,000 savings, then maybe you can put maximum 2,000, and again, that's a lot for you to trade. Okay, so please be very careful when trading. 5 things to take into account when determining risk levels in Forex. 1 is the leverage. 2 is the risk-reward ratio per trade. 3 is the maximum risk exposure. 4 is correlation risk, and 5 is event risk. Let's go over all these risk factors together. Leverage. The leverage determines how much funds you can borrow from your broker on every trade, given your cash balance levels in your broker account. Let's give an example. If you have 100,000 cash or equity in your broker account and have leverage set to 1-to-1, this means you are not trading on margin and cannot receive a margin call. If you open a 100,000 position long USD JPY and the USD moves up by 1% against the yen, then the gain on your account is $1,000 or else 1%. So 1% the move up, then you gain 1% of your position, which is 1,000. This is because you have your leverage set at 1-to-1. If, however, you're using a higher leverage, 5-to-1, 10-to-1, or 20-to-1, then a 1% rise in the USD yen will result in a higher percentage move in your account. So 5-to-1, 10-to-1, etc. But this works both ways. And if the USD yen moves against you, then you can suffer losses greater than the equity invested in that trade. So i.e. you get a margin call. Okay, so you need to be very careful. This can result in your positions being closed automatically by the broker. The best traders use 1-to-1 ratio to 5-to-1 leverage. 10-to-1, 20-to-1, 50-to-1, 100-to-1, 400-to-1 is exceedingly risky and is not recommended. You might find some brokers offering these things and even higher, especially in the past, but now you should be focusing on this area here. Okay? And of course, you should always start with a demo account, right? We'll discuss this at the end as well. Determining risk levels, risk reward. This is the second factor. Before buying or selling lots in a currency, it is important to set your risk and reward per trade. So every time, here it is. So every time you place a trade, divide your potential gain in pips after your take profit level is potentially triggered by your potential loss in pips, should your stop loss level be hit. So basically, if your potential gain in pips is 20 pips, then your stop loss should be 10 pips. So you should aim for a risk-reward ratio of 2-to-1. The risk-reward ratio should not be close to 1 or less. So if you're aiming for 20 pips, you should not expect, you should not set a stop loss level of 20 pips as well. However, depending on if you are a short-term scalper or generational trader, your risk-reward levels will naturally vary depending on your appetite for volatility. Duration trades means you expose yourself to higher volatility, so you should have more headroom required. So you should have more headroom for the stop loss. So you should be a bit less than 2 to 1, so 1.5 to 1 or something. I extend your how many pips you can go in loss before actually becomes a win. But again, this brings in a lot of risk as well. When your positions on duration trades are in profit to a desired level, you may wish to consider moving your stop loss, dynamic stop loss or trailing stop loss management, in order to lock in ensured gains with zero downside risk. Basically, in Forex trading, you have the ability, when the price has already moved towards your direction, i.e. you're already in profit, then you can move your stop loss closer to the current price, so you lock in again, right? So whatever happens, so even if the price moves down, then it will hit your stop loss, which is actually means that you have gained a bit of profit. So this can be done either manually, or you can have a dynamic stop loss or a trailing stop loss. Okay, so please be aware of that also when you're trading. This will make your trades a bit safer. Next one, maximum accounted percent exposure. It is important to set your trade dollar amount so that your capital is protected and that no trade is more than a certain percentage of your total capital. Determining the appropriate percentage can be done mathematically or manually by assigning a manual stop at X%. For less experienced traders, we suggest that no single trade setup should cause a loss greater than 5% to your total account equity. Again, 5%. Okay, so if you have, let's say, $1,000 account, then if the stop loss is met of your trade, you should only lose up to $50. Okay, keep that in mind. For more experienced FX traders, we would recommend considering the Kelly risk management criterion that uses historical success rate profit factor per trade to determine a percentage risk level. But again, if the output is more than 5%, be mindful that a manual stop loss of 5% will be preferred. And this is the Kelly risk formula for all of you that are more advanced traders. Okay, but again, a rule of thumb is 5%. Okay. Correlation and event risk. Entering multiple currency pairs, for example, long USD JPY, short Euro USD, poses correlation risks as the two pairs are inversely correlated somewhat because they both have the USD currency inside the pair. It's recommended to short-term or scalp trade on the majors, Euro USD, USD JPY, GBP USD, in an uncorrelated manner. Trading low liquidity peripheral pairs, USD TRY, USD PLN, could impact your ROI owing to cost of positions in terms of spread. So basically this means that lower liquidity pairs have a higher spread. So that puts you immediately in a worse situation, especially if you're doing especially doing scalping, short-term trading. But for duration trades, this is less of an issue. Okay. In all times, correlation should be avoided. Again, so you should not be trading currency pairs that involve the same currency. A good place to see which pairs have the highest levels of positive and negative correlation, please Google correlation heatmap and you can find free widgets and tools that can help you determine which pairs are correlated. So you should not only take the USD if the same currency pair exists in the same currency symbol exists in two pairs, but you should also look up for a correlation heatmap. Okay. As for event risk, when entering a trade, ensure that you are aware of the economic calendar and that no major events will trigger your stops prematurely. So before entering a trade, you should always look at your economic calendar, okay? And never enter into a position just prior to news, because then it's just gambling. You don't know how the news is going to be, and trying to guess the news is gambling as well, okay? So please be very aware when you're about to trade. Now, another issue another risk is that a very common practice engaged in currency trading is martingaling. This is extremely risky and it's not recommended at all. Martingaling means basically doubling up your amount of a trade when the trade is not moving your way, assuming then that for the second trade you will make up also the losses of the first trade. Okay, this is a recipe for disaster. Dollar cost averaging is gently building a position in a rising or falling market in order to get a better average price. This is safe. This is safer. But outright doubling of positions incessantly is a recipe for account ruin. So instead of, let's say, what is the difference between martingaling and dollar cost averaging? This means that instead of taking a position, let's say, of $100 at a certain level, price level, you take a position of $50, and then when the price moves against you, then you take another position of $50. So overall, you have taken a slightly better position than what you would have taken initially with $100. Okay, but it's basically splitting your initial amount into smaller accounts, in smaller amounts, and then entering those amounts, entering trades with those amounts when the price hits certain of your levels. But just doubling up with this multi-galing, then it's a bad thing for your accounts. So please do not do it. The reason is that the market can stay trending in one direction for years, right? Which is longer than you can stay solvent. So no matter what, avoid using greed trading or martingale strategies. Now, let's get into some currency trading dangers. First of all, do not trust robots. 99% of them are scams that are driven by affiliate marketers that are not traders. Expert advisors are very dangerous and very few work on a longer term basis. Be very careful. 5% of traders make money in Forex in the long run. So understand that in order to beat the markets for a living, you need to take time to understand the strategy and the system. Otherwise, you're just gambling. Blowing your account is not a bad thing. It is part of every trader's journey to eventual success, and teaches you the flip side of making trades, namely money management, which is a skill in itself. Start small, set leverage level small. So for every one of you that what I just read and said sound bad, let me just elaborate a bit. Every trader has blown an account. Every trader. Okay, it is normal. It is how you learn things, and it's also how you learn how to manage your emotions. At first, you don't know that much. I mean, if you manage to trade without blowing your account, then that's amazing, right? So you're one of the very few that actually do it. But most likely it will happen. So, and it will happen at the beginning of your career more often. So be aware of that. Always start small. Always start with small leverage levels, and always start with a demo account first, right? Now, moving on to the next part. 5% of signal services and signal rooms are legitimate, so be very careful when investing your hard-earned money into them. Always ask for a performance record and an audit trail. So this is it for today's presentation. It's now time for questions. And if you have any further questions to the one that we'll discuss today or anything else, please send your email to webinars@hotforex.com. Please send me your questions if you have any, and please note that this webinar has been recorded. Hello, Gavin. This webinar has been recorded and will be available within 48 hours inside your Hot Forex panel. So when you log into your account, there is a section for all webinars, and you will be able to find it there. Again, this will be available up to you in about 24 to 48 hours. Okay, here's a question. How do you deal with position sizing and risk to reward? I don't understand how they work together. Okay, let's go back. Here you go. So basically, okay, let's discuss this question before discussing the next one. So how do you deal with position sizing and risk to reward? I don't understand. Okay, so basically, let's start with two things. Let's start with maximum exposure, position sizing. Your loss should never be, any loss you have should never be more than 5% of your capital. Okay, and this goes to Bruce as well. No loss should be more than 5% of your capital. Now let's apply this 5% of your capital to your risk reward ratio. Okay, the risk reward ratio should be around 2 to 1. So let's assume you have an account with $100, just to be with $1,000, just to have the maths easy. Okay, 5% of your total equity for $1,000 is $50. Okay, so when you're placing a trade, you should be putting a stop loss so that you do not lose more than $50. Okay, which is what we said, and then your take profit should have to be around double that, so $100. And now how that results in pips, it depends on your leverage. But if we assume that $1 is per pip, right? Let's assume that for now. Then you can take 100 pips. You will set take profit to 100 pips and stop loss to 50 pips. Okay, this is how you can actually combine the two. So first you start at the maximum is 5%, and then you go to the risk reward ratio 2 to 1. So this is how you deal with it. Bruce Gordon, I assume that the 0.01 amount that you mentioned is in lots, right? I don't know exactly how that compares to the amount that you have in your account. Please check that, because I don't know the currency as well and how it will all relate. But what I just mentioned can be applied to your case as well. So if this 0.01 gives you too little money and you feel emotionally exhausted, then you might fall into this category, which is basically, let me just find it, that you have too little amount in your, I have it somewhere. Yes, having too little amount in your account. Okay, then if it results to too few of an amount, then it's probably not worth it, and you're gonna maybe result in over trading in order to cover that amount, to have a bigger amount. So please be aware of that. I don't know exactly the currency rate and that it is with your amount, but this is the logic. You're welcome. Okay, I see no further questions. This is the last call for questions, everybody. Okay, question coming in. When do we reevaluate the position size, weekly, monthly, or each time we take profit? No, you should basically do it, Jeremiah, at a monthly basis. More or less, it always depends on how aggressively you're trading, but it should have to be every 2 weeks to a month, depending on the amounts you're trading. There's no set rule, but you can do it every 2 weeks to a month. Again, it depends on the sizes that you're taking. But if you take it, if you are trading normally, so following all money management rules, every 2 weeks to a month should be fine. Okay, Mace is asking, some people say that reducing your leverage slows down profits. Is it true? Yes, and sorry. If you're a successful trader that is only taking profits, so you're only winning your trades, then I guess it is true. But nobody's like that, because nobody's like that. Okay, so there is a downside to what these guys are saying, is that if you're using a high leverage, then your losses also are higher. So leverage magnifies your wins and magnifies your losses as well. Okay, and because there are a lot of emotions involved, you should find a balance between the leverage that you should have. It is true that they can slow down profits of a profitable trade, but also they would reduce also the losses on a loss-making trade. Okay, so it's up to you. Leverage, again, I will repeat, magnifies your results. Okay, it magnifies the results. So if you would be making profit, then you will, with the leverage, let's say, of 1-to-1, then you will be making profit with leverage of 10-to-1. And if you're making losses with leverage of 1-to-1, you're making losses with a leverage of 10-to-1. You're welcome, Mate. There's another question saying how to combine the risk management with money management. These are two different things. These are two different things, but they are correlated. Okay, so because risk has to do with money, and so it immediately is correlated. Okay, so let me say this, how can I phrase it? From a money management perspective, you should always stay at 5%. But this also handles your risk. The Kelly risk formula helps you with the risk, and 2-to-1 here also helps you with the money and the risk. Everything is risk has to do with money. I cannot take one out of the other. You're welcome, Mate. And Gambil Goon, please rephrase your question if you want me to answer it differently. Sorry. I see no further questions, so I would like to thank everyone for attending the webinar. Please note that the webinar has been recorded and will be available to you inside your Hot Forex panel. Sorry, I got a last question. How much do I risk is become as a reward? Am I right? How much do I risk is become as a reward? Yes, but this depends on your risk-reward ratio. So your take profits and stop loss. This is what we discussed here. So when you're setting your stop loss, let's say at 20 pips, and if you're taking your take profit at 40 pips, then if you're risking, let's say $20 to gain 40. I don't know if this makes any sense. So the risk-reward ratio, your take profit and your stop loss levels determine your risk, but also the $20 loss should also be that percentage of your total capital, which should not be more than 5% of that. Hopefully this makes sense. No, do not apologize. Everything's fine. Thank you very much for asking your questions. I hope I made it clear. You too. So everyone, thank you for your time, and you can watch the webinar again inside your Hot Forex panel. If you have any questions, please send them over to webinars@hotforex.com, and have a great day ahead and a great 2018 to you and your family. Goodbye.